Welcome to Financial Revelations. I am David Safransky, your host, and you could hear me every Thursday morning, in the mornings, of course, on WCRF 103.3. It's Moody Radio, and if you have the Moody Radio app, you don't even need to turn on your radio. You can just listen on the app. It's the Brian and Janelle Morning Show every Thursday morning from 8 to 9. You can call in, you can ask questions, or you could just listen, up to you. I like when people call in and we get questions, and we do get a lot of questions. So it's a good time to answer that stuff. And I'll be there until they fire me, which I can't believe they haven't done yet, but here we are. And, today I was going to talk about COVID and the impact on jobs and things like that and what it's doing to the economy. But I'm data dependent here, and the Fed raised interest rates by 0.75% today, or 75 bips. So we're going to talk Fed, and I thought you might like my my headwear today, Stagflation. Stagflation is an economic term that is defined by higher interest rates, higher prices, and lower stock prices, higher unemployment, stagflation. So a lot of things aren't working, and really when the Fed has to raise into kind of a declining market, it really presents a lot of problems, and I think we have a little stagflation. I have another hat. Hold on. Don't go anywhere. We've been saying this for a long time. I don't know if you could read that or not. Inflation is not transitory. Inflation is not transitory. So the Fed raised 75 basis points today. This is the largest raise at a meeting by the Fed since 2004. Now, I don't want to get bogged down on all that, because when you think about what was going on in 2007, 2008, and then up until just maybe about a year and change ago, you could keep rates low because there was really no inflation. The Fed was really trying to create inflation, and they couldn't do it. So what does it mean to consumers? What does inflation mean to just you and me? We're going to the store, we're living our lives, we're doing things, we're buying and selling. Well, first of all, you may have noticed that mortgage rates in the last 30 days have skyrocketed. They're up over 6%. They were at 6.33% for a 30-year fixed mortgage this morning. They're probably going to be, I can't see them going to 7 yet, but they're certainly going to be probably around the 6.5 range in the next week or so. So the mortgage rate on a 30-year fixed mortgage is going to be somewhere around 6.5%. Well, we're just 2 years ago, we were under 3%. So the cost of money, the cost of buying a house, has gone up dramatically in a very short period of time. The rise from 5 to 6 1/3, dramatically fast. That's going to slow down the housing market. It's going to slow it down really quick too, because people had sold their houses. They were probably on a sub 4% loan, and now they got to go out and get a 6% loan. That really changes perspective, and it increases the cost of your house. So when people were looking at that 4-bedroom, 5-bath, 4-car attached garage at 3%, now they can't afford that. I'm going to wait this one out. And so you're going to see the housing market slow down. Credit card interest rates are going to, they're already high, but they're even going to go higher. Now listen, if you listen to this podcast or you follow me at all, I do not want you running balances on credit cards. When you run a balance on a credit card, it should be the first sign that something is wrong. Alarm bells should be going off in your head, because you're buying things that you can't pay for. And now there are times where that may make sense in business, but for consumer debt, if it's things like restaurants and consumable goods, I don't want us to be doing that. That is not good finance. So here's how you manage credit cards. You go out and you use your credit card as much as you want. I don't care how much you use it. However, you pay the balance off every single month, and then you won't pay interest charges. That's what you do. All loans are getting more expensive. So when that happens, life gets more expensive. Life was already expensive because of inflation. And we know It is not transitory. So it's going to get more expensive. Who is to blame for inflation? Well, I get a lot of criticism about this, especially on the radio, for my opinion, but the lion's share of the blame for inflation is on the Biden administration, not specifically Joe Biden, but he's in charge. He's the president. When you look at the new Green Deal and what it's done to gas prices, oil prices, and they did a stimulus plan, a $1.9 trillion stimulus plan into a growing economy that didn't need it. And so I blame 60% of this inflation on the administration. It is definitely the lion's share of their fault. 20%, I would say Ukraine, because that does cause a pretty massive dislocation in food supplies, grains. Russia is a big oil producer, and so those oil flows, that supply is in question. So that is causing some inflation too. And I'm going to throw the last 20% on the Fed because they should have been acting last year. Now, I understand why they didn't, because the administration was throwing stimulus in and they were going to act and raise rates. Well, they couldn't do it, or they didn't think they could do it. Well, that was a mistake, and they should have done it. So 60% on the administration, 20% on Ukraine, and 20% on the Fed. The thing is that the Fed is starting to act now. Okay, and eventually Ukraine is going to be settled. The administration is not getting off the Green New Deal. They are not going to allow more oil to be pumped. They're not going to allow that to happen. They want you to drive an EV, even though a new EV costs about $50,000. There are some cheaper, but there's just not a lot of supply. They haven't been around long enough. The used car market in EVs is pretty tight, just like the used car market and everything. So it's going to be tough. It's going to be a very, very difficult transition. So what is it going to take for inflation to come down? What is it going to take? We had an 8.6 inflation rate year over year, month over month was higher. It is going in the wrong direction. It's getting hotter, not cooler. And that's why the Fed did 75 basis points today. I'm starting to think that the Fed is going to have to push us into a recession at some point in time. And how do they do that? They just keep raising interest rates. In the late 70s, when the Carter administration was making every mistake possible and inflation was going higher and they just couldn't get a grasp on it, Paul Volcker came in as the Fed chairman, and he knew right away there was going to be no soft landing. It was going to be higher rates, painful. The economy didn't grind to a halt, but it was very, very difficult. And, inflation kills middle class and low income families because they can't afford the price increases. The recession kicks them while they're down. And so if they do have to push us into a recession, and I think we'll know before the end of the year if that's going to be what happens, because they're going to probably do 75 basis points next meeting. That's 150 basis points, 1.5% in 2 months. That is those are some pretty big rate hikes. Now, the rate that the Fed, the overnight loan rate, will still be relatively low, but we're getting to where we're going very quickly, and that creates some dislocation. So I think we're going to start to see by the end of the year if the Fed's going to need to do even more. I'm hoping that they don't. I'm hoping that inflation subsides. The problem is gas prices are not going down. And so if gas prices don't go down, everything's going to stay elevated in price. Now, they could stop rising, and that would be less inflation, but they're not going to come down. And what we need is prices to come back down to where they were January of last year. I don't know what happened January of last year to change all this, but something occurred. I don't really know what it was. So if they have to drive us into a recession, we're going to know, I think, by the end of this year. And who's going to hang for this? Who's going to pay the price? Someone's got to pay the price, right? We live in a society where we say, okay, this happened. Who's at fault? Now, I think that the Biden administration is mainly at fault. The Democrats are going to pay the price in the midterms for sure. I think that die is cast because we're still not at peak inflation. And every time they lose a month, so if in July the number comes out for June and it's hot, well, they've lost the whole next 30 days because there's not another number coming out for 30 days. So every time they lose 30 days, they lose campaign time. And the Republicans mainly the Republicans pick up time. And so I think the die is cast for the House and the Senate to be flipped. That's going to be the beginning of the payout process. Somebody's going to pony up and going to have to pay this bill, and it's going to be them. I think that the Democrats most likely are going to hang politically in November. Now, it's not going to help gas prices one bit, not one iota. It will help the market because the market likes divided government. But gas prices are on a trajectory to be over $6 by the end of summer. And the reason it's not going to change in November is because Congress does not control energy policy. The Congress can write a resolution, they can vote on things, they could do a lot of things, but they don't control oil and drilling rights. They don't control mineral rights on federal lands. The Interior Department does, and that is under the guidance of the administration. So no matter what happens in November, the Green New Deal is going to stay intact, and it's going to cost Americans, really the world, a lot of money. And so if inflation stays high and increases, I think that there's no doubt that the administration is going to lose the House and the Senate. And then you have really a lame duck presidency because the Republicans are not going to be in any hurry to help out the Biden administration on anything, on anything. And, the oil companies, it's strange because, the price of oil is high, but it's not oil companies that are making most of the money right now. And the reason for that is because oil companies sell their oil for 4 months from now. They're selling it now. They're doing it in futures contracts. They're doing it in a lot of ways. And so it's traders that are making most of the money on this, not even the oil companies. Now, to be fair, oil companies are making more money right now. There's no doubt about that. But when you look at, and I've heard calls for excess profits taxes and things like that, all ludicrous, un-American. But when Facebook was making $1 billion plus a quarter, nobody called for excess profits tax. It's when it's something that affects us on a daily basis, they start doing things like that. If we were just to open up the drilling, if we were to open up federal lands and go back to the Trump era policy on energy where we were energy independent, oil prices come down, not overnight, but they would come down relatively quickly. That's not going to happen. That's why I think we have not seen peak inflation yet. We will probably see peak inflation towards the end of the year because once summer ends and people are driving a little bit less, back to work, kids are back in school, you do see oil inventories build a little bit, and I think that's when you'll see peak inflation. Not great news today. It just wasn't great news. It wasn't great news all week. The market's been hammered. Now, the market did like the rate hike a little bit, mainly because it looks like the Fed is finally getting serious about inflation. And it's really hard to get in front of inflation if it gets too bad. Jimmy Carter found that out in the late 70s. You got to get in front of it. And the Fed's trying to do that right now. So I'm hoping they can do that without causing a recession. And again, we'll know that by the end of the year. I am David Safransky. This is Financial Revelations. You could email us a question if you want to ask us a question, how inflation is going to affect you personally, or anything about markets, investing, saving, spending, buying a house, selling a house. You could email Joshua at EPSF.com. It's going to be right up here. And he will forward those questions to me. He kind of picks them out and says, here's the ones that we should answer. And you can also, if you're on Twitter, I don't really like Twitter, but I go on it because of news. It's SkiBucks1, at SkiBucks1 on Twitter. You can throw questions at us there too. Remember, WCRF, Thursday mornings, 8 to 9. You can call in, you can text in, you can tune in. And they have a great app that my wife uses to listen to me no matter where she is. So I am David Safransky, Financial Revelations, and I'll see you next week.